This is 5 ways that you could become a more profitable trader. Let's get right into it. First off, if you guys watch my prior videos, we talk a lot about not trading breakouts or breakdowns. There are momentum traders, and it could be profitable, and it is profitable for some. But if you're first starting out, especially if you are trading option contracts, you are going to be in for a hell of a roller coaster ride. It's not going to be easy. You need a strict plan. Trading options versus trading commons is 2 completely different ball games. One has time decay and one doesn't. You could literally hold it, especially if this is an investment as well. You could literally hold it for however long you want and it's fine. But with an options trade, you are going to be getting killed from data decay. A lot of people like to trade weekly options or 2-week options. So if it doesn't go your way, man, you are going to get clapped. So one of the ways I like to trade is reversals, and I still only trade reversals. I barely ever trade breakouts. Personally, for me, I think that reversals have a way higher probability, and you are also making a lot more for what you put in. For example, let's go into Tesla. Sorry for all the lines and stuff, but I like to draw something called supply and demand levels. So if you want to learn, just comment below. Let me know what you guys want to learn or questions that I can answer, and I'll try my best to do so. But as you can see here, Tesla recently rebounded heavy and went up close to 30% from its most recent pivot low, which was right here. Now, why are reversals so much better than trading breakouts? You guys will have to watch the video that I released already. I believe it's already on my channel. Just dig through the playlist. But just to break it down very fast, if you trade a breakout, let me see if I can find something here. First of all, where does the term fake out come from? That's from trading breakouts. So a lot of the time people are getting faked out and then they get screwed from trading these breakouts, especially if you have a volatile market and it just decides to dump because of some news, then you are cracked. Let's look for like a breakout trade here. I mean, technically speaking, this is a breakout. You do get a huge move. For example, if you traded the breakout of this bullish wedge here, you could have potentially reaped close to a 12% move. So that's great. No one's saying that it isn't. In the case that you are able to capture this move, that is amazing. Now let's give another example. You see this huge wedge forming, which I'm just drawing from, just from seeing it right now. Not doing any research into it, and even this channel. So you have this channel or flag, a long, huge flag, and you see this wedge coming right into the flag support. Then you see this doji here being printed, and we closed above the flag. Now that will give you a nice trade, and this is a reversal trade because we are obviously counter trend when it's going down. As you can see here, we also have the stochastics showing a buy signal. You don't need a lot of indicators and stuff like that, but anyways, it comes down to this level and you're trading a reversal. Even if we cut out the whole consolidation that we have right here, you are looking at a huge 27% ripper. Now, this is just breaking it down from what we have here, but if this breakout did not work and you got faked out, you have close to a 16% move down for, let's say, the flag support, or maybe if you could find some sort of support and resistance within that, which I'm pretty sure you can, you are risking a lot more when if you entered over here, you are literally probably just going to risk a daily or 4-hour close beneath this candle after you got that confirmation candle right here. So let's just say, you know, a 3% risk that you are risking compared to this 16% risk that you are taking. And that's one of the reasons why I like trading reversals and why you should trade reversals, to higher the probability of your trades, especially if you are not a professional. Because a lot of these people, with a click of a button, they sell in, out for these breakout trades. That's number one. Number two is to stop letting people influence your trades. So a lot of the time you get into a trade, and I have a trading partner as well, very, very good trader, Corneck, on Twitter, Corneck Trades. And a lot of the times, and sometimes, we have different opinions on what the trade is. However, when you do something like that, you are, one, going to doubt yourself. Two, you don't know what he is looking at versus what you are looking at. You don't know the time frame that he is looking at versus what you're looking at. So, you know, if I saw this or if I saw this, I would be bullish. Does it mean I am short-term bullish or long-term bullish? Are you, you know, longer-term bearish, etc.? So, you know, someone here might be like, oh, it might go down lower and hit, you know, this level right here or whatsoever. So you're going to be doubting yourself. You're not going to be following your plan, and you're just going to be in the crap show. So to raise the probability of your trade, you must stop listening to other people. Number three, stop retrospective thinking. And this goes with letting people influence your trades, because this, you are influencing yourself. You become, when you retrospective think, you're thinking about what could have happened. So, you know, let's say if I traded this right here, let me just clear out my chart so that is more clear for you guys. If I traded this channel, let's draw the channel. If I traded this channel, more than likely, if I entered here, my take profit would probably be here, here, and here. Reason being, this was a prior rally-based drop. This was another rally-based drop. And that's where I would place my take profits. Now, obviously, if I got out here or even here and it goes up all the way to this level at $1,200, I'm going to be thinking to myself like, crap, I could have made this much money, or whatever. The problem with that type of mindset is that the next time you take a trade and you follow your plan, you're going to start doubting your plan and think, hey, I think I could actually make more money here. So that is where the problem lies, not in the fact that, you know, you could work around a different strategy or implement something else, maybe scale out a little less on the first one and then start scaling out more and more, or, you know, alter those type of things. But when you start retrospective thinking, subconsciously, the next time you trade, you're going to be like, hey, I think I could get more from this. And that's where the problem lies. And that's where it brings down your probability of a profitable trade. And that's why you should stop retrospective thinking. The fourth one, swing trading. Instead of trading 0 DTEs or weeklies, a way to become more profitable is to swing trade. Give yourself a lot more time on your options contracts so that you don't get killed by the Greeks. Swing trading is to me at least, is very profitable. Obviously, right now we're going through a lot of volatility, a lot of news. So swing trading is somewhat difficult. Now, in times like this, you know, scalping is really nice, which brings us to the next point. And again, swing trading will be one way to higher the probability of your trades. Also, because you might find yourself taking less trades when you're swing trading compared to when you are day trading and you're forcing trades. Number 5 would be, which is connected to swing trading, is looking at larger time frames. Looking at larger time frames, you are able to identify, like here, where you see this just rebound, places where more than likely institutions are watching rather than retail traders. You're able to identify levels where you get a huge move down after, like for example, this would be a rally base drop. And as you can see, if you were to just remove this side from the picture, this doji was formed and then we get the downside, right? The most important part isn't this initial down, but you can clearly see that we went up based on the daily, then came back down. Now what you have to watch is here when we make that move back up. And when we make that move back up, what do you see? You see that it rejects it and we come even further down. And this is why trading supply and demand is so useful. So what you're looking at here is a doji being printed, and this would be considered what you call a rally base drop imbalance. When an imbalance happens, there are orders that the institutions want to take out before they continue to either accelerate or decelerate the price action. So here, the fact that we based and then we dropped so fast within a short period of time, institutions are looking at potential orders that are still here. So they pump it right into that level, hit the stops, and then bring it right back down. That is what supply and demand is, and that's why it's so profitable and makes your trade so much more higher probability, because you're trading what the big guys are trading and you're not trading, you know, breakouts or something like that. Again, you can obviously make money doing any strat as long as you have a proven strategy. But to me, this is a lot more less stressful. You don't need to be constantly watching your computer. You don't need to do this or that. Trade with the right tools and trade with the right team. Thank you.